Hi everyone, and welcome back
Hi guys.
to another session of Live Debt Free. As mentioned last time, this week we'll be touching on investments again. And last week we just looked at the basic principles of investments. If you missed that, do have a look back. Some really good pointers there which you can carry through in most things, including business as well as personal finance. But today we're going to continue. We're going to be looking at, just very briefly, the different types of investments. So we won't go into too much detail because we could spend literally hours defining each different type of investment. But Orita will just give us a very basic breakdown of the key different types of investments. Of course, there may be a few more out there, but we just thought we'd highlight some of the most important ones. So where would you like to start, Rita?
So I think the whole idea behind this is really to demystify the whole concept of investments and to really make it palatable for everyone, right? So the first thing, and probably the most widely spoken about one, would be shares or stocks.
Yeah.
So investments are also, or different types of investments are also referred to as asset classes. So it's literally basically what are the different things you can invest in. That's just what that means. So shares, how I can easily explain that is just, it's a piece. Just what the word says. It's like you can think about it as a piece of a pie.
Yeah, okay.
Right? So what you're doing is you're owning a small tiny bit of a company. That's what a share is.
Okay.
And then how that benefits you is that you will earn interest, dividends, or as the value of the company grows, so your piece grows as well.
So it's, if I understand correctly then, the better the company does, the better your share does.
Absolutely.
And if the company doesn't do that well, then your share doesn't do that well.
Right.
Yeah.
And so it's like owning a piece of Coca-Cola or Apple is popular, right? And here is where we can bring that investment principles from last time in and look at it. If you use all your money to buy Apple, for example, does that satisfy the principle of not putting your eggs in one basket? Sorry. Okay.
Cool.
Yeah.
So we got shares covered. What's next?
Next one is bonds. Okay. So bonds is simply you are making a loan to either a government or a big company or a little company. Now, governments are considered less risky. Big companies a little bit more risky, and small companies very risky. And in exchange for the loan that you're giving, you will earn interest. The catch is that it has to be with that company or with that government for a fixed amount of time.
And is the interest rate fixed on that as
Yes.
well? And it's a fixed interest rate. So I didn't actually know that a bond is you actually giving money or lending money to the government. I really didn't understand that concept. So yeah, that's really interesting. So just to clarify, a bond is you actually assisting a company or government with their specific investment plans, and it's over a fixed period of time and a fixed amount of interest.
Right?
Cool.
That's bonds. So it's very simple. Shares, you get a piece of a company.
Yeah.
Bonds, you give a loan out and you earn something back for a specific amount of time.
What's next?
Okay, the next one is mutual funds. This has been the buzzword for the last
2-3
ages.
decades. Yeah. Who
Right.
knows?
So basically what a mutual fund is there's a fund company or an entity. They collect money from different investors like you and I, and then they make decisions on where to invest that money. Their goal is to get the highest possible return by running different calculations and models. I won't profess to understand, to make as much money for the fund as possible. So if you can think about just a few of your friends pulling your money together and then collectively making an investment, that's exactly what mutual funds are. Now, there's so much depth in the mutual fund subject that we can't go into today.
No, we won't go into too much detail, but it's just to give you a brief outline of what's out there. And what we would recommend is, again, going back to our investment principles, know exactly what you're investing in. So it's up to you to do the homework and research on any of these different types of investments thoroughly.
Right.
So if you're going to do mutual funds, go and study, do the research, understand it fully. We're not here to give you all the information on a plate.
Right. If you have questions about mutual funds or you would like another video going into a bit more detail, we can do that, but that's not for today.
Yeah.
Okay.
Cool. And next.
The next one is exchange traded funds.
Okay.
So this one is exactly like a mutual fund. It's also many different investors pooling money together, but these funds are traded like shares on a stock exchange.
Okay.
Okay, so they are low cost, but the difference between this one and mutual funds is exchange traded funds usually are not professionally managed, and that's why they can keep the costs low. They are traded like a share on an exchange, and they mirror a particular type of index.
Okay.
For example, a group of companies, the top companies in the US, that's called the S&P 500. The exchange traded funds will mirror that.
Okay.
So there's no decisions being made by fund managers.
Right. So if I understand correctly, then the key difference is, one of the key differences to compare that to mutual funds is that mutual funds are managed independently in terms of the dividends, etc.
Right.
Yeah?
Yeah.
Okay, cool.
Okay. The next one is probably, we don't have to bother with that, but it's hedge funds. I just wanted to quickly touch on it because you hear these words and I just wanted to make you understand it's easy.
Yeah.
Hedge fund is, it's a mutual fund as well, but it's usually for very high net worth individuals.
Right.
There's a lot of studies being done that they don't perform that well, but usually the guy on the street like you and I, we can't get access into that, into those funds. Okay.
Yeah, for the longest time I thought a hedge fund had something to do with hedges, but or lawns, but it clearly doesn't.
No.
But one thing I wanted to mention on all these different investments is, firstly, like I mentioned, understand absolutely everything that you are investing in. But then when it comes to investments, you've got to decide, because there's always going to be a risk element affiliated with that. Decide between you, if you're single, or together, if you are husband and wife, what sort of risk profile you fall under. Are you high risk, medium risk, or low risk? And that will also determine, of course, the different percentages, the returns on your investment, etc., etc., etc. For example, Rita's pretty high risk. I am low risk.
Sure.
So all our investments are sort of low to medium, right?
Yeah.
Yeah.
Well,
compromise. This could be a marriage course as well.
True. Okay. The next one is gold.
Okay.
Wow.
Getting to commodities.
Right. I wanted to single out gold from the rest of commodities because especially the country we live in, we hear so many people that have their faith in gold. And I know it's there's a historical element to that as well.
I think it's a sort of old school cultural thing. Just like our grannies used to believe in putting your cash under the mattress.
Right.
So it's all these different sort of ideas we need to try and approach and also get a better understanding of. Because at the end of the day, you want your money to make money.
Right.
So yes, sorry, carry on.
No, that's fine. Gold. So gold, you can either buy a physical bar of gold, or you can buy it through an exchange.
Yeah.
There are also, just like a stock exchange, there's a commodities exchange, and they'll have a couple of different type of commodities listed on them. Now, gold is considered to be high risk, actually. Even though we notice that when the stock market's in trouble, people tend to run to gold because the price of gold is inverted to the stock market. So it goes up when the stock market is down. So it's kind of like a safety net for a lot of people, but the return is really, really not good when you look at it over an investment lifetime. So I'm talking 20 years, 30 years, and that's what the aim is, right?
Exactly.
To invest consistently over time.
A long period of
Right.
time.
So gold is not a good idea if you're looking for that
Long-term return on investment.
and it doesn't satisfy the principles. It's not diversified.
No, and you can get a higher return on other sort of things. Again, these are just our opinions and takes and views on our experience. Don't send in hate mail just yet. We're just giving a very broad perspective, and a lot of this is through our own experience. So I think we're working down the list to things that I understand a bit more now. So what's next?
The next thing is commodity funds as well, which is, I touched on it a little bit earlier. So when people say commodities, it can be sugar, it can be energy, oil and gas, things like that.
Natural resources.
Metals.
Basically, right?
Yeah.
Natural resources.
Right. So those are also
not nappies.
No. Those are also volatile, but they do hold some value in your portfolio. We don't really do that. No. We don't recommend it necessarily, but it's something for you guys to explore.
Yeah, I mean, different things work for different people, like we say, and you got to decide together. Once you understand everything, you've worked out your risk profile, what works for you, and exactly what your goals are. What is your idea for return on investment? And yeah, just to reiterate again, investments are a long-term sort of platform. So you can't be looking, oh, it's up, down, it's down today, it's up tomorrow, it's down. No, you got to look at it at least with a 15 to 20 year forecast.
Right.
And that's the aim.
Yeah.
You know, because as statistics have shown, in every 10 years there's bound to be some form of catastrophe which may affect the markets.
Absolutely.
So and we've just had one.
Right. We're going through one right now.
We're going through one. Yeah. So just bear that in mind.
Yep. The final one, which I actually forgot to mention earlier to be high on the priority, is property, guys.
Something I understand. Yay!
So there's a few ways we can do property. So you can own your own home that you live in, or you can have an investment property where you're a landlord and you earn rental income. Or actually there's something called real estate investment trusts, which is just like a mutual fund almost. It's a company that buys different real estate, and you can own a little bit of it, and you'll earn rental income in the same, not rental income, but you'll earn a dividend in the same proportion that they grow in capital and that they're earning income as well. So if it's a lot of work to be a landlord. There's hidden costs that people don't necessarily think about.
Some of you are landlords, so you're pretty familiar with this. So.
Maintenance, all service fees, etc. So real estate is, I also feel like it's a very traditional must-have for people, right? And it's a good investment.
It is a good investment, and generally the returns you get again over a period of time are, and it's pretty low risk. In mature markets, it's pretty decent. I just want to mention now that we are discussing properties, and we've mentioned this in budgeting and all our other previous videos. If you are investing in anything, investing means you have money, right? You're not borrowing money. So just bear that in mind. If you are considering a property as an investment, you need to either buy cash, I know, easy, or have a really, really high deposit over the shortest amount possible, shortest time frame possible to pay that back, because it is a risk at the end of the day, and we all about risk avoidance.
Diminishing risk.
Diminishing risk. Diminishing risk. It's a better phrase. I try to avoid it totally, but you can't. So just bear that in mind. If you are considering property as an investment, make sure you've got all your other ducks in a row, which we've been speaking about.
Absolutely. I would not do an investment property with borrowed money.
No.
I might say okay for your personal residence, but for investment property, I just don't think that that's good.
There's just too many things that can
Good
go wrong.
financial management. Yeah.
Absolutely. Is that it?
That's it.
That's it. Wow, we've covered so much.
There's so much more probably.
Yeah.
But I think those are the most
Those are
common ones.
The vital things to consider in terms of the different types of investment. So, hope you enjoyed it. Please do keep sending in the questions. Do also message us with anything you'd like us to cover. You can contact us on our social media. So right here is our Instagram, and right here is our Facebook account. This is our YouTube channel. We have podcasts as well, and our website is www.livedebtfree.me. So you can reach us through any of these platforms. Do get in touch. Do like, subscribe. We sound awful like all the other YouTubers, but apparently this is what you have to say. And share it. If you think this will benefit someone, share it with someone, because we're here to try to be a blessing to people, and to help in a small little way in which we can. So till next time, take care, keep well, stay safe, and make that
change. Bye guys.